We often hear about the magic of compounding, the way small gains can blossom into significant wealth over time. But what if I told you that the simple formula we all know is just the tip of the iceberg? That true wealth compounding isn't just about numbers, but about understanding the hidden forces at play. Forces that can either accelerate your growth or silently erode your potential. Are you ready to look beyond the surface? This isn't another get-rich-quick scheme promising overnight riches. We're uncovering the hidden truths behind wealth accumulation, the data-driven insights that separate successful investors from those who simply hope for the best. It's a journey that demands intellectual rigor, a willingness to challenge conventional wisdom, and a commitment to understanding the underlying mechanisms of the market. Think of compounding not as a simple calculation, but as a complex ecosystem. Each element influences the other, creating a dynamic that's constantly in flux. And just like any ecosystem, it's governed by certain principles, hidden truths that, once understood, can give you an undeniable edge. Benjamin Graham, the father of value investing, wisely said, "The intelligent investor is a realist who sells to optimists and buys from pessimists." These words act as a compass, guiding us through the emotional turbulence of market cycles. The ability to recognize and capitalize on these emotional swings is a critical component of true compounding. It's about seeing opportunities where others see only risk and avoiding the pitfalls of irrational exuberance. Don't just invest, understand the why behind every decision. So, prepare to challenge the consensus, find your edge, and embark on a journey to unlock the full potential of wealth compounding. Are you ready to become a truly data-driven investor? The first hidden truth about compounding is something I call the illusion of linearity. We often visualize wealth growth as a straight line, a steady climb upwards. We expect each year to deliver roughly the same percentage gain as the last. But data reveals a far more interesting pattern. Compounding isn't linear. It's exponential. Imagine a hockey stick. The blade represents the initial years, where progress seems slow, even insignificant. You're diligently saving, investing, doing all the right things, but the needle barely moves. This is where many people get discouraged. They fall prey to recency bias, judging the potential of their long-term strategy based on short-term performance. They see the flat part of the hockey stick and underestimate what's to come. But then, something remarkable happens. As your base grows, the returns start to accelerate. The hockey stick starts to curve upwards. The seemingly small investments you made in those early years now form a foundation for substantial future returns. The power of patience and a long-term perspective becomes undeniably clear. Think of it like planting a tree. The initial years require diligent nurturing, watering, fertilizing, protecting it from the elements. For a long time, you see little visible growth, but beneath the surface, the roots are expanding, creating a network that will eventually support a mighty tree. Compounding wealth is the same. It requires consistent effort and a belief in the unseen potential. It's a slow burn that ignites into a financial forest. The second hidden truth is the silent wealth killer, inflation. It's a hidden tax that quietly erodes the purchasing power of your money over time, diminishing the real value of your compounded gains. You might see your investments grow on paper, but if inflation is outpacing your returns, you're actually losing ground. It's not enough to simply beat inflation. The goal is to achieve a real return significantly above inflation to build substantial wealth. Think of it as running on a treadmill. If you're only moving as fast as the belt, you're staying in the same place. You need to run faster to actually get ahead. Consider the analytical skeptic who diligently saved, believing their high-yield savings account was a safe haven. They later realized that inflation was devouring their purchasing power, rendering their efforts almost futile. This realization sparked a quest for high-returning investments, a journey fueled by data and a healthy dose of skepticism. How do we defend against this hidden tax? Explore inflation-hedging strategies. Consider investing in commodities, real estate, or inflation-protected securities. Understand how these assets tend to perform during inflationary periods and incorporate them strategically into your portfolio. Don't let inflation silently steal your future. Protect your compounded gains with vigilance and informed action. The third hidden truth is the behavioral tax. Our emotional biases act as inner saboteurs, leading to irrational investment decisions that disrupt the steady path of compounding. Fear, greed, and overconfidence can cloud our judgment, causing us to buy high and sell low, the exact opposite of what intelligent investing demands. We fall into cognitive traps like confirmation bias, seeking out information that confirms our existing beliefs, blinding us to contradictory data. Loss aversion makes us feel the pain of losses more strongly than the pleasure of gains, leading to panic selling during market downturns. Anchoring bias causes us to rely too heavily on initial information, preventing us from objectively re-evaluating our positions. How do we mitigate this behavioral tax? Data-driven strategies are our defense. Implement automated investment plans, removing the temptation to react impulsively to to market fluctuations. Diversify your portfolio, reducing the impact of any single investment on your overall returns. Conduct thorough due diligence, grounding your decisions in facts, not feelings. Imagine your portfolio as a garden. Emotional biases are weeds that must be constantly removed to allow your investments to flourish. Tend to your financial garden with discipline and self-awareness. By understanding and counteracting these biases, we pave the way for smoother, more predictable compounding. The fourth hidden truth is reinvestment risk. We often focus on the initial investment, but we overlook the challenge of finding equally attractive opportunities when those investments mature or generate returns. It's not enough to simply earn a good return. You must also be able to reinvest those returns effectively to sustain compounding. Consider historical interest rate cycles. Declining interest rates can significantly impact reinvestment opportunities, forcing investors to accept lower returns or take on greater risk to maintain their previous income levels. This is where a flexible investment strategy becomes crucial. Rigid adherence to outdated strategies can blind you to emerging investment trends, hindering your ability to find suitable reinvestment options. The story of John Bogle, the index investing pioneer, reveals the importance of low-cost, diversified investment options to mitigate reinvestment risk. By spreading your investments across a broad range of assets, you reduce your reliance on any single investment and increase your chances of finding attractive reinvestment opportunities. Adapt, evolve, and remain vigilant. Reinvestment risk is a constant challenge, but with a data-driven approach and a willingness to adjust your strategy, you can overcome this hurdle and maintain the momentum of your compounding journey. The fifth hidden truth lies in the concentration versus diversification paradox. Diversification reduces risk, spreading your investments across a wider range of assets. But concentration, focusing your capital on a smaller number of high-conviction ideas, can potentially amplify returns. The key is understanding the trade-offs. Data reveals that both concentrated and diversified portfolios can succeed or fail depending on market conditions and the skill of the investor. A concentrated portfolio can generate exceptional returns if your high-conviction ideas perform well, but it also exposes you to greater risk if those ideas falter. A diversified portfolio offers more stability, but it may also limit your upside potential. The appropriate level of concentration depends on your individual risk tolerance, investment expertise, and time horizon. If you're a novice investor with a short time horizon, diversification is generally the safer approach. But if you possess deep knowledge of a particular industry or company and you have a long time horizon, a more concentrated approach might be warranted. Focus on investments within your circle of competence, those areas where you possess a genuine understanding and edge. Don't let societal narratives distort your perception. The concentrated investor isn't necessarily reckless, and the diversified investor isn't necessarily risk-averse. What matters is informed decision-making, grounded in data and a clear understanding of your own strengths and weaknesses. We've journeyed together through the hidden landscape of wealth compounding, uncovering truths that often lie buried beneath the surface. We've explored the illusion of linearity, the silent tax of inflation, the sabotage of behavioral biases, the overlooked hurdle of reinvestment risk, and the paradox of concentration versus diversification. Remember, wealth compounding is more than just a formula. It's a system, a complex interplay of forces that demand our attention and understanding. Data-driven decision-making is your compass in this journey. Challenge conventional wisdom, question assumptions, and develop your own independent investment strategies, grounded in facts, not feelings. Cultivate a long-term perspective, resisting the urge to chase short-term gains at the expense of long-term growth. Warren Buffett wisely said, "Someone's sitting in the shade today because someone planted a tree a long time ago." This simple statement encapsulates the essence of compounding. Consistent effort and patience are the seeds you sow today that will blossom into financial security tomorrow. The path to wealth compounding isn't always easy. There will be setbacks, challenges, and moments of doubt. But by embracing these hidden truths, by cultivating a data-driven mindset, and by maintaining a long-term perspective, you can unlock the full potential of compounding and build a future of lasting wealth. So, as you embark on your own compounding journey, remember this: are you ready to plant the seeds of your future today, knowing that the shade you enjoy tomorrow will be a direct result of your efforts?